Hello, my name is Joseph Mathew. I'm your local real estate agent. I'm here with Travis Scott with Southwest Funding, and we're going to have a little conversation about the best ways for you to get a mortgage, and so we can get you into your dream home. Travis, why don't you tell us a little bit about yourself?
Well, I've been in loans for 16 years. Graduated from University of North Texas up here in Denton. Married up, outkicked my coverage, and we've got 6 kids, so big family. And like I said, I've been doing loans for a long time, so this has been my only career. I started on a Monday right after I graduated from high school or college on a Saturday.
Oh, so, wow.
Yeah, this is all I've ever done.
And you've been doing this for, again, I'm sorry?
16 years.
16 years.
Yeah.
Wow. So you're a pro. You got this.
Yeah. I mean, I've seen it. Been through the market turns, and if it's out there, we've seen it. So.
That's good. Yeah. That's good. If, let's say somebody, before they apply for their mortgage, right? What are steps that somebody can take to make sure that they get the best mortgage possible?
I think the first thing is to check their credit. I mean, that's one thing that I've seen a lot of, is that people aren't even aware of where their credit stands. And you can do that for free. You can go to each one of the credit bureaus, Experian, Equifax, and TransUnion. You can pull one report a year from each for free. And at least they'll give you kind of a barometer on where your credit is. If there's anything that you weren't aware of, say, medical bills that may have been in collection, you never got the bill. So that's a pretty common thing. And then just start educating yourself, talking to people like yourself or myself, and just start asking questions. I'll tell you what they shouldn't do.
Okay. All right. That might be a better list.
I think one of the things that they could be really cautious of is there's so much information online, and there's lots of confusing information. So it's good to read up and be educated on things. Absolutely. But I would just be real cautious of where they go, and maybe talk to a person in addition to just reading online, because there's just such a mountain of information out there that it can be really confusing. Okay. Also, it's really common for people to say, "Talk to Uncle Ed." Everybody's got a relative in their life that's an expert on everything. Yeah. And so just be real careful of that too, because you don't know, they might be giving you advice that applied 10 years ago or 15 years ago when they bought a house. Okay. That could be very different now. And
so they could be kind of outdated.
Yeah, outdated, and just maybe inaccurate to what guidelines are now for loans. I mean, our industry changes all the time. So, guidelines update, requirements are different. Loan amount limits change, things like that. So again, it's just important to get somebody who's an expert in the field. Okay. And if you go to the right person that's got a servant's heart and that wants to educate and just spend time with them and help them through, it's going to be a lot better than just say going to a .com lender or a .com real estate agent. Yeah. Because that's just going to be a transaction. That's just going to be churning and burning. Okay.
Perfect. What's the overview of the mortgage process from start to finish?
Well, let's see. In a nutshell, it's basically the customer would call up or apply online with a lender. The lender's job is to take a look at their application. So there's 4 C's to a mortgage application. You've got your credit, right? So we do a review of their credit. You have the cash, so how much they have in assets or, money that they can bring to the table for the down payment and closing costs and such. You have capacity. That is the debt to income ratio, right? So how much can you afford based on your current debts and the new mortgage payment against your income? And then the 4th is the collateral, so the actual house itself. Okay. An appraisal, the condition of the home, the type of home, manufactured home, or a stick-built home, or a condo, or what have you. So those are the 4 C's of the application. My job is to review all of those. Okay. And then, verify the income and the assets from the borrower. Then we gather all that stuff up. We have an appraisal. We send it to underwriting. And then it's our job to be that conduit between underwriting and the borrower to get what we need. And then we set up for closing. And so they sign with the title company. Here in Texas, you have to sign at the title company. So, on most loans. Yeah. And then that's when they fund, and that's when they become homeowners, once the funds are dispersed and they get their keys and everyone's happy.
Okay, perfect. So how does someone know what's the best mortgage for them?
Well, that's a great question. There are literally hundreds of programs. We can do variations on all different kinds. The best lenders out there will provide options, and that way the borrower can make their best decision. And it depends on the borrower, because some might be strapped for cash. So they need a loan that has little to no down payment, or some down payment assistance. Some have plenty to put down and they want to pay off their house aggressively. So we could look at a shorter term loan, 10 or 15 years, something like that. Some have credit blemishes. So they need a loan that is going to be more forgiving as far as their credit history, but it still allows them to get in a home. It really is a case-by-case basis. There's no cookie-cutter situation. I think what a lot of people find is when they venture out online or they see these commercials on TV and everything can be done on your phone, you might be dealing with, somebody who doesn't have all of the options available to you, or they won't present all the options available. So it's important that the lender and the buyer work together to kind of come up with a game plan. Okay. And then really just let the buyer make their best decision for them and their family. So there's all kinds of programs we can look at. It's about tailoring the right one to their specific need at that time.
Okay, perfect. What are some things that you see that people do during the loan process that either helps them or hurts them in getting a loan?
Yeah, that's a good one. It just had this one the other day, actually, where a customer went out and financed some furniture before closing, which is a huge no-no. So please don't do that. They got all excited about their loan approval, and they went out to Nebraska Furniture Mart or wherever it was and just started financing. And I was like, that just changed everything. So don't change your credit. Don't lose your job. I've had that too. Where people have actually lost their job or changed jobs. They were working for one company and they got a raise. They got a promotion or an opportunity to make more money at a different company, and that you really just shouldn't do that during the loan process. So that can really hurt you. Okay. So even if it is a promotion to a different company, that can hurt you? Right, because it depends on how they pay you. I mean, if it turns out to be more of a commission-based situation and there's no history of that, that can be an issue. If you go from, say, a W-2 to a 1099 position, you're now self-employed and you got to have a 2-year history of that. Okay. It can be problematic if you do switch jobs during the loan application. I don't recommend it. Okay. Certainly consult with your lender before you make any decisions like that to find out how that's going to impact your loan. Cool. As far as doing things during the loan that are good, keep paying your bills, keep documenting everything you have, every paycheck that while you're in the loan process, keep sending your pay stubs and your bank statements, keep sending any documentation that you have for deposits that are coming in we have to source those deposits. So just paper trailing everything during the loan application is great. Well, I would say another thing that's good is just to, keep asking questions, because borrowers are, again, bombarded with information out there. And so just, if something comes to your mind, you're not sure how that applies to you, or even if it does, keep asking questions to your lender, because they should be able to answer those questions. Yeah. So better be safe than sorry kind of situation, where if there are any financial kind of changes that are happening, it's best to double check with the lender, kind of see what they need to do. Yeah. If there is anything to do, or if that's a good or bad move. Right. Don't assume anything. Okay. I've had more loans blow up at the end because the borrower thought this was a good idea, that I'm going to deposit them in cash. Maybe they'll sweeten the deal if I have more assets. Well, your loan was already approved with the assets you had. So depositing cash now just completely wrecked this deal. So check with, don't assume anything. Always ask your lender about the loan. Okay, good. There's a typical misconception out there that you need 20% down payment. So is that true, or what other options do people have? Yeah, great question. It is not a requirement you have to have 20% down. There are loans that you can do 0 down, depending on where you buy. If it's in a rural area and you qualify with your income, you can get USDA, which is 100% financing. Of course, veterans can do a VA loan, and we certainly love working with the veterans, because that's a way for us to give back to them as well. That's a great program. But even on a conventional deal, there are loans that are as little as 3% down. A standard conventional minimum is 5% down. So you can get into a home with a lot less than you think you have to. Plus, that down payment money can be from a gift. So if you've got a parent or a relative that wants to help you get into a home and they have money set aside, you can use that gift money to get into the house. So it's really not out of your pocket. Okay. And of course, with all of that, there are down payment assistance programs available. So many options to get in with less than 20% down.
Okay.
Now, if you do have 20% down, it sometimes can be a good thing. You can avoid having private mortgage insurance, which is PMI. Just it's another layer to your payment. And so if you can put down the 20%, you avoid having to pay that as far as your monthly payment.
And how much additional is that PMI?
Depending on how much you start your loan with, like what loan to value you start at, it's usually, like on say a $200,000 house, $250,000, anywhere from, $80 to $150 a month in additional payment. So there's a long formula that we use software for.
Yeah.
So it calculates it for us.
Okay.
But yeah, it does. It is. But once you get to 22% equity in your home with a conventional loan, that PMI can go away.
Oh, okay. So it automatically stops once you get to 22% equity.
Yeah. Well, it's eligible to be taken off. You probably need to consult with a lender handling your payments to get that removed.
Okay.
But I will say with FHA, which is a government-backed loan, the PMI will last forever, regardless of how much equity you have in the house.
Oh, wow. Okay. Yeah. That's a good thing to know if you're debating between a FHA is what, 3.5% down?
3.5% down.
And conventional 5% down. If you can make it happen, then the PMI will kind of go away, right?
Yeah, it can, sure.
Okay.
The great thing about FHA, though, and it's a really good loan, people have, that's another misconception, it's a bad loan. It's a good loan. They're very good interest rates. And they are designed for people that have a little bit less to put down, or maybe have some blemishes on their credit.
Okay.
So it can still get very good pricing terms as far as your rate, even if you've got some dings on your credit.
Okay, perfect. What can somebody do to make sure they get, let's say, the best interest rate on their mortgage?
Certainly want to review their credit ahead of time to find out where they're at and if there's things that they can take care of, because that's really what's going to drive the rate is the credit.
Okay.
The type of loan, whether it be USDA, VA, FHA or conventional, can have a bearing on your interest rate. The higher the scores, the better the rate typically. I mean, that's just how it works. So what would be considered a high score? Really anything north of 720 is going to get you the top tier pricing, 720, 740 and above for a conventional loan. Okay. Now, if you're, say, above 700 on an FHA, you're pretty much at top tier pricing and VA as well. Okay. So monitoring your credit's the best thing to do. Now, people always ask, well, I've got a ton of money in assets. Is that going to help my interest rate? Not really. No, I mean, your rate is based off of the amount that you're putting down and the credit score. So yes, a larger down payment can help your rate because there are some breaks that you get for, a lower loan to value. To be perfectly honest with you, that's one thing that the borrower would want to consult with their lender on, because if you put a lot of extra money into your house to get an eighth to a quarter better in rate, we have to really do is it worth it? Okay. Because you could take that money and put it into a vehicle that'll actually make you money, right? An IRA or a 401k or something, some other investment. If you put it into your house and you're saving minimal amount in your monthly payment, you won't see that money again until you either cash out, refinance, or you sell your house. So it depends on the goal of the borrower. If they want to be debt free and not have a mortgage, well, great. Pay off your house. Okay, perfect. But if they're looking to save money and they're spending thousands more down to save minimal amount on their payment, and they can afford the higher payment, then maybe take that money and drop it into another vehicle that can make you money, and it would offset. So again, that's just a strategy that they would want to consult with their lender about. Okay. Probably when they do their research online, they'll see that they can buy down their interest rate. So can you go into a little bit more detail about that? Yeah, especially in this market where we've seen a little bit of increase in rates. That's a real common thing that we're presenting to buyers now. So a discount point or a point on a loan is 1%. And so what we can do is, one strategy is we'll charge a 1% upfront discount point. What that is, it's prepaid interest. Okay. So you're prepaying some of your mortgage interest, and in exchange for that, you can get your rate lowered. Typically, it's about a 1% discount point to a 0.25% in rate. Now, it depends on the day because interest rates change daily. It's a very fluid market, but that's a pretty safe range, for calculations, I guess. 1% discount to a 0.25% rate. Okay. So we present that to our borrower. We say, okay, here's your standard rate with no discount points. Here is your interest rate with a discount point. And, here's your cash difference. Here's your break even. So it may take, on average 4 to 6 years to break even on the monthly payment savings versus the cost of the discount point. So if they're going to be in their house long term and they plan to, 5-10 years, it makes sense.
That's good to know. And so let's just say if somebody were to work with you, you would clearly state where the discount point, what savings you'll get, and where you break even.
Yes.
Okay.
Yeah. So we present them both estimates along with a loan comparison software that they can actually go in and click and play. And it's an interactive loan comparison, so they can see where the money is going and how it changes over time, along with appreciation. All different kinds of tools that they can use.
Okay. Perfect. Typically, a mortgage payment, people just think about the loan amount. Can you go into a little bit more detail about escrow and what all payments are included in that?
Yeah, great question. That's a big issue that I see, especially with first-time buyers, because a lot of the calculators you'll find online don't factor in taxes and insurance. So they see a payment, they're like, oh, I can afford this. This is so cheap. And then they come to find out, well, now they have to pay $400 to $600 more a month. And they weren't planning on that. So basically, escrows are a 12th of your taxes and a 12th of your insurance, and that's added to your principal and interest on your payment. Okay. So what we do, and if a buyer wants to find out, you can usually search that property with the appraisal district of that county. Okay. So like for Dallas County has got, a website for that. You can search the address of that property and then it'll tell you their annual taxes. So you take that divided by 12 and there's your monthly amount. Same thing with homeowners insurance. They can either call their agent or ask their lender. We have some pretty good guidelines as far as calculations. Okay. To take a 12th of that and add it to your payment. And then again, depending on how much you're putting down, you also could have PMI on top of that. So it's not just your principal interest. You have your taxes, your insurance, and mortgage insurance. Okay.
That is what they should account for when they're thinking about purchasing a home. That's their upfront or monthly expense that they can, just from home ownership, is what they can expect.
Yes. Okay. And I will always tell my borrowers, especially first-time buyers, to be real conservative. Think about 1% of how much you're borrowing, right? So if you're borrowing, it's a $200,000 house, you're putting down, 5% or so. They need to think about an $1,800 to $1,900 payment. Now, it's probably less than that. Okay. But you don't want to be house poor either. Yeah. Right? So it's better to overestimate because you got water, you got utilities, you got to replace the tires in your car. So you don't want to be cash poor on a house or house poor. So I always, in a general sense, it's safe to budget 1%. Okay, perfect. Like a total 1%.
Yeah, that's a good general guideline to know how much you can afford and what you can spend on your house. So when they're closing on their house, right, their closing costs, and that's like, I guess, initial costs that are associated with the loan. Can you go into a little bit more detail about that?
Sure. Closing costs they're going to vary a little bit, but most of the time there are standard fees, regardless if it's a $500,000 loan or a $50,000 loan. There's just the cost to do business. So you have your lender fees, which is typically processing and underwriting. Now that can all be negotiated whenever we look to lock in terms on how we cover that or what's being charged. So, but in standard cases. Then there's also your third party fees. So you've got like appraisal, you've got title work, survey, inspection costs. There's an array of third-party costs that are just a part of the transaction. So people always ask me, well, is there a percentage amount of the loan that I should budget for closing? And it really just depends on the size of the loan because, again, there are fixed costs regardless of loan size. So that percentage gets really high when it's a small loan amount. And depending on if you put down 20%, you also have the flexibility of not escrowing your payment. So that's less money that we have to collect at closing to build those escrow accounts. So what you want to be real careful of as a buyer is to make sure that you're able to see an itemized fee worksheet so that you know exactly what is being collected and it's broken down. If you just see a lump sum $6,000, well, what is that? I want to know what that is, or any hidden fees in there, or am I paying a discount point or not? So you want to have a fee worksheet that breaks down everything and have your lender explain where the dollars are going.
Okay.
You know, and that'll be and then once you know, I mean, you know what it is, and it's a standard. It's usually a standard amount or a standard fee structure regardless of the loan amount.
Okay. Perfect. What's the standard application time frame? Like, so if they're deciding to buy a house from the beginning of the process to when they close on the house, like for the loan purposes, how long is that time frame?
Typically, a 30-day close is pretty safe.
Okay.
From contract to close. What we typically see is that we will start that process even before then. So I may get a referral from a realtor for a client to get pre-approved. So it may take, depending on how fast the borrower can get us what we need, like their income and asset documentation to review. Okay. It may take a couple of days for that. And then once we have a pre-approval letter that we can issue, once they get a contract, it's usually about a 30-day close. Now, depending on the loan, whether it be a government loan like a VA loan or USDA, there's some third-party transactions that have to happen during that process that could stretch out the closing a little bit. Okay. But overall, or if you're buying a mobile home, that could add a few extra days. Okay. But overall, a 30-day close is pretty safe. Okay. Now, we can certainly do them a lot faster than that if need be. Everybody just has to be on the same page to do that rush together. Okay. I mean, we've closed them in as little as 7 or 8 days. Oh, wow. It just depends on, I mean, I'm not promising that every time. But on a standard, a 30-day close would be fine. Okay, perfect. Yeah.
And now you mentioned in there pre-approved. What's the difference between pre-approval and pre-qualification?
So pre-qualification is really worth the paper it's written on. Okay. So that basically means a customer's filled out an application either on the phone or online. Okay. And based on what they put in, as far as their income goes, or maybe even a credit score, a lender says, well, you're pre-qualified then for this. And that's real common, especially with like .com lenders. Yeah. What a pre-approval is we've actually reviewed their income. They've sent us their pay stubs. They've sent us their tax returns. We've verified the information that they put in the application. We have pulled their credit. Okay. So we know where their debt to income ratio is. We've verified their assets or where their down payment's coming from. So we've actually put eyes on their documentation. Even sometimes we'll do, depending on the situation, if they're self-employed, maybe they've got a ream of paper for tax returns because they own lots of companies. Well, in situations like that, we'll actually do a full TBD underwrite, which means we don't have a property yet, but we've sent a full file to underwriting. And so we have a true underwritten approval. It doesn't have to be a self-employed. We can do that for any borrower. Send a full approval underwriting, and that way you guys, as real estate agents, know that all we are waiting on is the collateral, which is the appraisal. Okay. And the house itself. And so as long as that underwrites, we can close very, very quickly. Perfect. But that's really the difference. So, because a big problem is, especially with self-employed borrowers, they think they do make a gross amount every year. Yeah. Some of them have very, very good CPAs. And so what they show on paper after their deductions is a lot less. Yeah. Well, if you're self-employed, lenders have to go off of the net. So whatever's left. Yeah. And so people may not realize that. It's like, I had a perfect example. I had a truck driver, guy had great credit, probably had a couple $100,000 in assets. It was a slam dunk deal. Yeah. He grossed over $400,000 a year driving a truck. His CPA was awesome. Oh, wow. He made about $30,000. Oh, wow. Yeah. Wow. $30,000.
Who's the CPA?
Yeah, right. I know. I don't know. I don't want to know what he did. Well, I mean, owning a truck like that, you have a lot of write-offs, right? Yeah. A lot of depreciation and whatnot. So, anyway, he couldn't qualify for a house, which is because he was trying to buy a very expensive home, and he only netted $30,000 a year. That was about a year and a half ago or so. There are programs actually out there, not to segue too much, there are programs out there specifically for this that have come back into the market called bank statement programs, where we can average the deposits of a self-employed person and use that as income rather than just the net off the tax returns. So that was a product that was really popular back in the subprime days. Yeah. And it has resurfaced. Okay. And but there's more parameters to it, but it is an opportunity for people like that to get into a home when they couldn't before.
Oh, perfect. Yeah. Once they've moved into their house, right? What is what are things that they can do to kind of pay off their mortgage earlier if that's what they choose to do?
So the easiest thing to do is to just make additional payments to their principal.
Okay.
Every month they have either, whether it's through electronic payments that they're doing or they actually get a statement in the mail, it'll have the ability to where they can make additional payments either to escrow or to principal. Mm-hmm. And so you want to pay it to principal because that extra payment goes to the back of the loan. Mm-hmm. And you're paying it, you're not, so that the additional money isn't applied towards the interest, right? Because in a normal mortgage, mm-hmm. most of your payment in the beginning is to interest, mm-hmm. very little to principal. As you move through the loan payments, more and more principal gets applied. Mm-hmm. So if you make additional payments to principal, it literally goes to the bottom line of what the actual principal balance is. Mm-hmm. And so if you can, one strategy is they will set up bi-monthly payments. Mm-hmm. So every 2 weeks they're making a payment, and so you're actually attacking the principal a little bit more.
Yeah, that's what I currently do. But yeah.
Yeah. Really popular strategy. Some lenders that are servicing your loan may charge you a fee to set that up. Mm-hmm. So you just want to investigate that. The exact same math is if you just make one extra payment a year mm-hmm. towards your principal. Mm-hmm. Because what that does is it makes it, if you're doing bi-monthly payments, that's 26 payments mm-hmm. a year. That's 13 months.
Full payments, right?
Full payments. Yeah. Mm-hmm. So if you just made one extra payment a year, mm-hmm. like if you got a bonus check or something like that, yeah. and applied that to the principal, that's the same math applies.
Yeah, or like a tax return or a gift or something comes out of nowhere.
Right.
Like just yeah. So.
And the other strategies, let's say you get down into a house. A common strategy we do is they'll look to refund. Like let's say they started a loan with 5% down. Mm-hmm. And in 2 or 3 years, the market's done well, especially recently. Mm-hmm. So appreciation has gone up. Well, then they will take that and they will refinance it into, say, a 20-year or a 15-year note. Mm-hmm. They probably have the 20% equity now, so they're not required to pay the PMI. And their payments actually might work out to be pretty close to the same, mm-hmm. yet their term is cut in half.
Okay.
Or they're saving 10 years off their note just by refinancing.
And using the equity in the house that... hopefully it's appreciated too, right? Like
right.
Depending on the market conditions, like in Dallas area, it's been pretty good using the equity in the house as a down payment almost in your refinance. Okay.
Exactly.
Okay.
And that would cover your closing costs.
Okay.
And it's just restructuring your debt mm-hmm. to shorten the term and then you could pay, you're just making those payments, you've cut off 10 to 15 years on your loan.
Okay, perfect. That's a pretty good strategy for people that, can get into a house now and kind of wait for the time for the house to appreciate and then kind of make that move. So mm-hmm. Thank you for that wonderful information, Travis. Where can somebody go to get in contact with you and get more information? So
the best way to do it is either have 2 ways, well, 3. Phone number is 972-232-7340. Mm-hmm. You can go to applywithtravisScott.com. Mm-hmm. And a very easy way to get calculators, to apply on your phone, which is a really simple app. You can text Southwest to 36260. So Southwest to 36230, mm-hmm. and you'll get my app sent to you, and you can put on your phone and have payment calculators, news. You can apply online. You can refer my app out. So that's probably the best, most tech savvy way we have.
Okay, perfect. I mean, yeah, especially, and that's a to-go solution, right? You can have it with you on your phone. Yeah. You can use it whenever. Perfect.
Absolutely. Yep.
Well, thank you so much, Travis. I appreciate it.
Yeah, my pleasure.
Thank you for the information, and it's going to be a great resource to first-time and return home buyers. So it's going to be a great, useful information.
That's awesome. Thank you.
Thank you.
Yeah.